everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 7 from the book Crypto Swing Trading by Jide George. It has been created with the help of AI. The chapter is titled Advanced Swing Trading Techniques. You can read the original post at samfury.com.
All right, so are you ready to really level up that crypto swing trading game?
I think so.
You got the basics, right? Buying, holding, riding those price swings. But today, we're going deeper.
Oh, cool.
We're going to unlock the secrets, those advanced techniques that could really boost those profits.
Interesting.
Yeah, we've got some really cool sources here that cover, well, pretty much everything. Leverage, arbitrage.
I've heard of that.
Yeah, and how, you know how crypto prices, they're all kind of connected.
Oh, okay.
Yeah, we're even going to get into like pro-level order types and technical analysis, the fancy stuff.
Nice.
But, one thing that really stuck out to me from these sources,
What's that?
it's easy to overcomplicate things, Like
Yeah.
way too easy.
Yeah, sometimes less is more. Especially in crypto, things move so fast.
Exactly. So we'll definitely be keeping an eye on that, making sure you walk away with like practical knowledge you can actually use.
Yeah, that's what I'm talking about. Actionable stuff.
Okay, so let's kick things off with something that I know a lot of traders are curious about, leverage.
Okay, yeah. I've definitely heard that term thrown around a lot.
Have you ever, seen a potential price move but wished you had more capital to really play it?
Oh, yeah, for sure. All the time.
Well, leverage, it's like borrowing from the future. It lets you multiply that buying power.
It sounds too good to be true.
Ooh, there's a catch, right?
There's always a catch.
It's a double-edged sword. So imagine this. You've got, let's say, $100 to trade, and you use like 5x leverage.
Okay, so I'm controlling $500 worth of crypto.
Exactly. Now, if the price goes up 10%, you've made $50 instead of just $10.
Wow. Okay, that's a big difference.
Right. But
Oh.
what if the price goes down 10%?
Oh, I see where this is going.
You've just lost $50 instead of $10.
Ouch. Yeah, that magnifies the losses too.
Big time. That's why all these sources are like really clear about this. If you're going to use leverage, keep it low,
Like how low are we talking?
like 5x max. And this is super important. Always, always manage your risk.
Makes sense. So how do we do that?
Risk management 101. Stop loss orders.
Right, those are like safety nets for your trades,
You
right?
think of it this way. A stop loss is an order that says, hey, if the price drops to this level, just sell my position automatically.
Got it.
It helps limit your losses, but just as importantly, it helps you stay disciplined, even when, like, emotions are running high.
Oh yeah, fear and greed can take over sometimes,
Yeah.
especially in crypto.
Because we all know how wild crypto markets can get, right?
Totally.
Okay, so next up, let's talk about a strategy that's less about riding those big waves and more about spotting those little inefficiencies in the market. Arbitrage.
Arbitrage. Okay. I've heard of it, but not sure I totally understand it.
Have you ever noticed that the price of, say, Bitcoin might be slightly different on different exchanges?
Yeah, actually I have. Why is that?
Well, that's where arbitrage comes in. It's all about taking advantage of those price discrepancies to make a profit. You're basically buying low on one exchange, selling high on another.
So it's kind of like buy low, sell high, but across different exchanges?
It sounds so simple,
right, like ridiculously easy money.
But I'm guessing it's not quite as easy as it seems.
Yeah, I bet there's more to it.
You're right. There are like fees involved in buying and selling, right? And then you've got to consider the time it takes to transfer your crypto between those exchanges.
Oh, right, because that takes time. And prices can change so quickly.
Exactly. Sometimes those price differences vanish in the blink of an eye. You need to be like super quick and calculate everything carefully. And there are, get this, even more complex types of arbitrage, like triangular arbitrage, that uses like 3 different cryptos and 3 different exchanges.
Whoa, okay, that sounds a little intense for me right now.
Yeah, maybe not something to like jump into right away.
Right, baby steps.
So for someone just getting started with arbitrage, what's like the key takeaway?
I would say focus on those major price differences, the small ones. They might not be worth your time, especially considering those pesky fees.
Got it. So next up, we're going to talk about how crypto prices are all connected.
Okay, yeah, I've definitely noticed that.
It's something I've definitely noticed in my own trading. Certain coins just seem to move together, like they're, dancing partners.
It's true. Like when Bitcoin goes up, a lot of other coins tend to follow.
That's correlation in action. You'll often see like altcoins mirroring Bitcoin's movements. If Bitcoin surges, they tend to follow suit. And when Bitcoin dips, they often dip too.
So how can we use this to our advantage? Is there a way to play that?
There's a technique called pair trading. Imagine this. Bitcoin's rallying, but Ethereum is lagging behind.
Okay, I'm picturing it.
A pair trader might buy Ethereum, and then simultaneously they short sell Bitcoin,
Yeah.
betting that the gap between their prices, it'll eventually close. They're playing the relationship between the two assets.
So you're not necessarily betting on which direction the market will go,
Right.
but rather how those two assets will move relative to each other.
Exactly. It's pretty clever, right?
Yeah, that's really cool.
And this ties into another important concept from our sources, diversification.
Diversification, yeah, that's like spreading your risk, right?
Instead of putting all your eggs in one basket, you spread your risk, but holding assets that aren't perfectly correlated. That way, if one investment takes a hit, your entire portfolio isn't, sunk.
It's like having a backup generator for your portfolio. If one power source goes out, the other one kicks in.
That is a great analogy.
Speaking of backups, before we move on to, even more advanced stuff, I think it's important to really emphasize something. Our sources hammered on risk management.
Oh, yeah. Risk management is key.
I mean, you can have the best strategies in the world, but if you don't manage your risk, well, it can all come crashing down.
It's like learning to drive a race car. Sure, it's exciting to go fast, but you better know how to handle those brakes.
Exactly.
So what are the key things to keep in mind when it comes to risk management?
Well, it all starts with, knowing yourself and your financial situation. Like, how much are you comfortable losing on any given trade?
Yeah, that's a good question to ask yourself.
That's your risk tolerance. And it's different for everyone, right? It depends on things like your income, your expenses, your overall investment goals.
So it's kind of like setting a budget, but for your trading.
Exactly. Know your limits before you even start. And then you need to think about position sizing.
Position sizing.
Yeah, like how much capital are you going to allocate to each trade? This ties back to your risk tolerance. You don't want to put all your eggs in one basket.
Right.
Right. And of course, stop loss orders are crucial.
Those automatic safety nets we talked about earlier,
Right.
it seems like they're even more important when you're starting to use these more advanced strategies.
Absolutely. Stop loss orders can help you stay disciplined. They can help you avoid those emotional decisions that can really hurt your bottom line.
Because, let's be honest, we all make those emotional decisions sometimes.
Oh, yeah. Fear and greed, they can take over in the heat of the moment. But a stop loss order, it's like having a predetermined exit strategy.
It's like telling your emotions, look, I know you might panic or get greedy, but we're sticking to the plan.
Love that. And finally, one of the simplest yet most powerful tools for any trader, especially when you're starting to explore more complex techniques, is, keeping a trading journal.
A trading journal. Okay, so what is that exactly?
It's a record of all your trades, not just your wins and losses, but the reasons behind each trade, your entry and exit points, your emotional state at the time, any lessons you learned, everything.
So it's like a diary for your trading journey, a way to reflect on your decisions and see what's working and what's not.
Precisely. By tracking your trades, you start to see patterns both in the market and in your own behavior. You might notice that you tend to make, impulsive decisions when you're tired or that a certain strategy just isn't working for you.
That's so interesting. I can see how that would be super helpful for, avoiding those costly mistakes and developing that self-awareness that's so important in trading.
It's a game changer.
Okay, so we've covered a lot of ground so far. Leverage, arbitrage, correlation, risk management, trading journals. Now let's move on to those pro-level tools we teased earlier, advanced order types and technical analysis.
All right, let's do it.
Now we're getting into the realm of fine-tuning your entries and exits and using some pretty cool techniques to try and, predict where the market might be headed.
Your crystal ball stuff.
Exactly. So let's start with those advanced order types. I know most traders are familiar with market orders and limit orders, but our sources mention some other tools in the arsenal.
Right. So with a market order, you're basically saying buy or sell at the best available price right now. It's, quick and easy, but you don't have as much control. With a limit order, you set the price you're willing to buy or sell at, and the order only gets filled if the market hits that price.
Right, so you're being more specific about your entry or exit point.
Exactly. Now let's take it up a notch. Imagine you set a stop price, and if the market hits that price, your order automatically becomes a limit order. That's a stop limit order. And it's a great tool for, volatile markets like crypto.
So you're combining the features of a stop loss order with a limit order. You're saying, if the price drops to this level, sell my position, but only if I can get at least this price for it. That sounds pretty smart.
Right.
Yeah.
And then there are trailing stop orders. These are like dynamic stop loss orders. As the price of the asset moves in your favor, your stop loss price follows along, locking in more potential profit. It's a great way to, protect your gains while letting your winners run.
Ooh, that's clever. Okay, I'm ready to get into the fancy math part of the show, advanced technical analysis. This is the stuff that always kind of intimidated me, to be honest.
I know, right?
Yeah.
It can seem a little daunting at first.
Yeah. But I'm intrigued by the idea of using like patterns and indicators to try and predict future price movements.
It's a fascinating area, and there's a whole universe of indicators and techniques out there. Our sources highlighted a few that I think are particularly interesting for swing traders.
Hit me with them. What are some of the techniques that caught your eye?
Well, one that really stood out is the Elliott wave theory. This theory suggests that, market prices move in predictable wave patterns that reflect the psychology of the crowd. It's about identifying those waves to try and anticipate future price swings.
Okay, so it's kind of like reading the waves of human emotion in the market.
Exactly. It's a complex theory, but it can be quite powerful if you learn to apply it correctly. And then you have things like Fibonacci retracement levels. These are based on a mathematical sequence that appears all over nature, and traders use it to identify potential support and resistance levels in the market.
Support and resistance. Those are the price levels where the market seems to pause or reverse direction, right?
Exactly. Traders often use Fibonacci retracement levels to pinpoint those entry and exit points for their trades.
So it's like finding those key levels, right, where the market might change direction.
Yeah, exactly. It can be really helpful for timing those entries and exits. But remember, no indicator is perfect.
Right, of course.
It's always important to look at, the bigger picture, consider other factors, and manage your risk carefully.
Always manage that risk.
There's one more technique from our sources I want to touch on: intermarket analysis.
Intermarket analysis. Okay, that sounds kind of intriguing. What is that all about?
It's about looking at the relationships between different markets. How does the stock market affect crypto? Or how do interest rate changes impact Bitcoin's price? Stuff like that.
Ah, so it's about recognizing that crypto doesn't exist in a vacuum. It's part of a larger, global financial system.
Exactly. And by understanding those connections, you can sometimes, anticipate moves in the crypto market based on what's happening in other markets.
Wow, we've covered so much today, from leverage and arbitrage to correlation, advanced order types, technical analysis, and even intermarket analysis. It's a lot to take in. What's the best way for someone to start putting all this knowledge into practice without getting totally overwhelmed?
I'd say the first step is to, just take a deep breath. Remember, you don't have to learn everything at once. Start by focusing on one or two techniques that really, resonate with you. The ones that click.
It's like going to a buffet. You don't have to try every single dish.
Exactly. Pick the ones that, look most appetizing and savor them. And don't be afraid to experiment. You can test out different techniques in a demo account or with paper trading before you risk any real capital.
That's a great point. It's like having a practice arena where you can try out those new moves without worrying about, getting hurt.
Exactly.
And our sources, they really emphasize the importance of keeping things simple, right?
Oh, absolutely. Adding too many indicators or, overthinking your strategy, it can lead to analysis paralysis. Remember, sometimes the simplest approaches are the most effective.
So it's all about finding that balance, using those advanced techniques to sharpen your edge, but not letting them overcomplicate your trading.
Exactly. And always remember, trading is a journey, not a destination. There's always more to learn. And the markets are, constantly evolving. So be patient with yourself, keep practicing, and never stop being curious.
Well said. This has been an incredible deep dive into the world of advanced crypto swing trading. We've explored some powerful techniques, but I think the most important takeaway is that, knowledge is only part of the equation. You've got to combine that with discipline, risk management, and a commitment to continuous learning.
Couldn't agree more. It's been a pleasure, sharing these insights with you and our listeners. I hope they feel inspired to take their trading to the next level.
And remember, you don't have to go it alone. There are amazing communities and resources out there to, support you on your journey. Do your research, find mentors you trust, and never be afraid to ask questions.
Well, on that note, I think we've reached the end of our deep dive.
Yeah.
I'm excited to see what our listeners do with all this knowledge.
Me too. And as always, a friendly reminder to do your own research, manage your risk wisely, and never stop learning. Happy trading, everyone.
Happy trading. Until next time.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.